What's up, you guys? It's Graham here. So have you ever wondered how so many people seem to avoid paying taxes legally, of course, even though they might be making a ton of money? Have you ever wondered how you could avoid paying taxes legally, of course, even though you might be making a ton of money? Well, you came to the right video. So here's how, and these are some of the strategies that you can use in real estate to potentially wipe out any tax you would owe on this income. Now keep in mind that these are all completely legal, and it's not like I'm talking about any magic witchcraft here, but it is very important to remember that every individual situation might be a little bit different, and it's important to speak with a CPA instead of listening to someone on YouTube for all of their tax advice. There we go. So with that said, let's get into the video. Now, number one is that any expense that you have in real estate is almost always a write-off against that income. For instance, let's say that you have a toilet that breaks in one of your rental properties and that's $100 to fix. Well, guess what? That is a tax write-off. Maybe you go and hire a property manager to manage that rental property. Well, what you pay that property manager is a tax write-off. Or let's say that you hire me for a one-on-one paid consulting call. Well, guess what? Most likely that would be a tax write-off. Just about anything you spend that's related to the income that you make in your business is seen as an expense, and because of that, it becomes a tax write-off against what you make. So let's take this as an example. You make $10,000 a year in gross rent. But then you end up paying $1,000 a year to a property manager. You then also pay an additional $500 a year in property taxes, and maybe you pay an additional $2,000 a year in mortgage interest. Then let's say you pay an additional $1,500 in random expenses related to that property. So now you've taken your income down from $10,000 a year down to $5,000 a year. And with that, you've decreased the amount of money that you would owe on taxes on that income. So even more now could be applied to that $5,000 to bring it down even further. And that brings us to step number 2. This is often how people can make tens of thousands or sometimes hundreds of thousands of dollars a year. But on paper, somehow they're showing they're making a loss every single year. And they walk away with all of this money completely tax-free. Now here's a very basic example to show how this works. So here's how it works in very basic terms. The IRS says that your property has a lifespan of 27.5 years. This means that every year that goes by, your property on paper becomes less valuable. Their reasoning behind this is that things wear out over time and needs to be replaced, and with that, things just get older to the point where on paper, after 27.5 years, your items will have worn out and you would need to replace them. Things like the roof or the water heater, maybe the foundation needs some work, or maybe the house is just it gets torn down after 27.5 years. You have to do the whole thing over again. But on paper, that is the lifespan of a property. And this is where that sweet depreciation comes in. This means that if your property, the structure itself, is worth $275,000, you divide that over 27.5 years, and that gives you $10,000 a year as a write-off, as depreciation on paper that is essentially your paper loss. So let's take the previous example here where you had $10,000 of gross rent and you brought that down to $5,000 after your expenses. But wait a second, now there's depreciation and you have $10,000 of depreciation against $5,000 of income that ended up in your pocket. So now you can actually show on paper that that property gave you a $5,000 loss after depreciation, even though you profited and made $5,000 in your pocket. That $5,000 could be seen right there as completely tax-free money. Now, it gets even more insane when people are buying million-dollar properties and just depreciating them insane amounts just to wipe out their income entirely. So people take this certainly to an extreme, but this is the general principle and exactly how it works. So with that said, let's go on to number 3. And this is probably one of the most used tax write-offs when it comes to real estate, and also one of the coolest, but for those that aren't aware of it, this is what's called the the 1031 exchange. This is really one of the best benefits of real estate, is that you can do what's called a 1031 exchange and pretty much indefinitely defer ever paying taxes on the money that you make when you sell a property, as long as you replace that property with a like kind, which means that you basically sell one property for another property and you don't pay taxes when you do that. So as a very basic example here, let's say that you bought a property for $100,000 in cash and now it's worth, drumroll, $300,000. This means that if you were to sell that property at $300,000, you would be paying taxes on $200,000 worth of profit. That, at just a basic 15% capital gains tax, would be $30,000 in taxes that you would have spent. That would buy you a lot of my Real Estate Agent Academy courses, link in the description, or that would also buy you a lot of my coaching calls, link in the description. So then you think about that and you think, well, I'd rather save that $30,000 because Graham Stephan recommended that in his video. And then you do what is called a 1031 exchange. So by doing a 1031 exchange, in that example, you're able to sell that property for $300,000 and then within a specified time frame, move that money into another property. Let's just say it's $500,000 and you defer paying taxes on the $200,000 of profit that you made. You've saved the money that you would have been spending in taxes and you moved it into a better, bigger deal that could then grow again. And then all of a sudden you do the same thing again. Now you've deferred paying taxes on your profit, been able to use that extra money to fund an even larger deal that then goes and makes you even more money. Now, of course, I am simplifying things a lot in this example, and there are plenty of specifics that you have to identify a few properties by a certain amount of time. You have to close on those properties within a certain time frame. So this is really just the basic blueprint outline of how the concept works. But this is really one of the best used tax advantages of investing in real estate that allows you to pretty much sell, buy, continuing to profit bigger and bigger and bigger amounts, completely with tax deferred growth that just lets it grow even bigger. Now, number 4, and this would probably apply to most of you watching if you own your own place, is, drumroll, the capital gains exclusion. This is also one of the major reasons why I disagree with Grant Cardone's buy what you rent, but rent where you live. I think I got that right, because that completely ignores this advantage of completely making tax-free money. The concept of this is very simple. If you own a primary residence and you live there for 2 of the last 5 years, you can sell that property up to $250,000 of profit if you're single, or $500,000 of profit if you're married, and owe 0 tax on that. Like seriously, where else can you make up to $500,000 of tax-free profit if you're married by simply just owning where you live? That's why this is so amazing. So in this very basic example, let's say that you bought a property for $500,000 in 2010, and then you got married, and now today that property is worth $1 million. This means that you can sell your property for $1 million and that $500,000 you just made is completely tax-free. Ordinarily, with any other investment like with stocks or anything else like that, you would have to be paying a long-term capital gains, which on that could be anywhere between 15 and sometimes 20% plus potentially state income tax on top of that. So this method would save you 15 to 20% or more on taxes, which could equate to 6 figures. You could save $100,000 by doing this over simply selling long-term capital gains stock with the same amount. So hypothetically, if you're married and can get $500,000 of extra value per home, you could be making $250,000 every single year simply by buying a property, adding equity to it, living in it for 2 of 5 years, and then selling it and doing that entire thing again, all tax free. Now, number 5, and this might seem a little common sense, but I have to mention it here, is that there is no tax on appreciation until you actually sell. This is similar to owning a stock, by the way, that goes up in price. You're not paying tax on that stock until you actually sell it. And until then, this profit is what's called an unrealized gain. Same thing applies to in real estate. If your property is going up in value 5% a year, your net worth is going up that same amount, even though you're not paying taxes on any of that additional net worth that you're getting. But wait a second, because I do realize that there are some people in the comments section right now just getting ready. Get ready to go and type some angry comments like,
Graham, that you can't use that money. That's not real money until you sell it. That's not dislike.
I'm glad you got angry and asked, because that leads me to number 6. This is what I like to call the cash out refinance, or HELOC, which stands for Home Equity Line of Credit. The benefit to doing this is that you get access to all the money that you've made completely tax-free without ever actually making any money. In the eyes of the IRS, you don't actually make any money until you sell. Now, since you're actually not really technically making any money, since you're borrowing against something you haven't sold yet, there's technically no tax to be paid. So in another good old example, let's say that you bought a property for $100,000, now it's worth $200,000. If you were to sell that property, assuming you weren't living in there for the last 2 to 5 years and it's just an investment and you're not doing a 1031 exchange, you would have to pay taxes on $100,000 worth of profit. So instead of doing that, you simply borrow the money that's already in the property. So you have that money, it's sitting there to pay off the loan at any time, but you're borrowing against money you already have. This is what I did with the duplex I recently bought. It was worth over $200,000 more than what I had into it, so I simply pulled out an extra $100,000 completely tax-free. This is an extra $100,000 that I made, more than that actually, that I didn't have to pay any tax on whatsoever, that I can then go and reinvest to make even more money. So this is my way of making an extra 6 figures without paying taxes as though I were making an extra 6 figures. Now the same thing also applies to a HELOC, which is basically like using your house as collateral, and the HELOC is almost like a credit card in that you can charge things to your house, and your house is used as collateral, and then you make payments to pay down the HELOC over time. Many people end up doing a HELOC, by the way, if they want to renovate a property. Let's say that they want to spend $30,000 on the kitchen, they don't have it, but they own their home outright. They can borrow the money from the home, renovate the kitchen, and add more value to the property simply by making some renovations. Now number 7, and this is one of the major advantages of getting rental income over just about anything else, is that rental income doesn't pay self-employment tax. Now usually if you're self-employed, you pay a 15.3% tax. Some of that goes towards Medicare, some of that goes towards Social Security, but it's about 15.3% of whatever you make. Now, even if you're an employee, and let's say you're on a salary, even employees pay a part of this self-employment income, except their portion is about half. So you're paying about 6.2% towards Social Security and Medicare if you're self-employed. But guess what? Rental income doesn't pay any of that. This means that rental income right off the bat saves you 15.3% in self-employment tax, and rental income versus your normal salary job is saving you another 6.2% or so, give or take, on Medicare and Social Security that you don't have to pay. This also doesn't take into account all the write-offs that you have, all the depreciation, your ability to do a 1031 exchange and defer more taxes almost like indefinitely. So there are a lot of advantages here of not only making rental income, but using some of these tax advantages in real estate to avoid paying taxes. Legally, of course. All right, now drum roll, number 8, and this is something that also would apply to just about anybody who owns a property, is what's called the mortgage interest deduction. The IRS says that with a rental property, you can deduct all of the interest that you pay against your rental income, thereby lowering the amount that you would pay in taxes on that income. Not only that, but with a primary residence, one that you're living in for yourself, you can deduct the interest off the first $750,000 of the mortgage that you have. So let's just say, as another very basic example, that you itemized your deductions and you made $80,000 last year, but you also paid $15,000 in mortgage interest last year. That means that that $15,000 could be subtracted by the amount of money that you made, which is $80,000, and all of a sudden you're paying tax now on $65,000 of income instead of $80,000 of income. That is often a good example of saving money by keeping a mortgage rather than paying it off early, especially if you have a super low interest rate, which I have in another video that some people either really disagree with or really agree with, but I'll let you make that choice, and the link to that is in the description. Now finally, number 9, and this is like the holy grail for all the real estate professionals out there. This is the best one. And this is what's called the title of being a real estate professional. Now, becoming a real estate professional opens up many advantages and many doors that some people just don't have access to. And now to become this requires two things. The first one is that you spend more time doing real estate activities than doing anything else. And the second is that you spend at least 750 hours per year doing real estate activities. The biggest advantage of being a real estate professional is that you can often use your paper losses to offset other earned income that you get. So remember that example where you had $5,000 of profit, but then you showed a $10,000 depreciation? Well, that means that you showed a $5,000 loss. But what can you do with that $5,000? Well, in this example, let's say that you made $5,000, let's say, mowing lawns. Well, all of a sudden, since you had $5,000 loss in rental income on paper, but you made $5,000 over here mowing lawns, you combine the two, and all of a sudden, that $5,000 that you made over here, poof, you don't owe any tax on that because all of a sudden, that depreciation wipes out the money that you made because you're a real estate professional. Now, I really hope that made sense. I hope that's basic enough. If it doesn't make sense, just comment down below, let me know, but I hope that example worked. So anyway, this is why becoming a real estate agent while also investing in real estate is the perfect combo, because this allows me to depreciate the properties that I have, where I show a paper loss that then goes and offsets the income I make working as a real estate agent, thereby lowering my taxes even further. Now, of course, non-real estate professionals can also benefit from this as well, but only if their income is below $100,000 a year, and this depreciation and this loss is capped at $25,000. So in this case, you're still able to do this up to $25,000 per year, but if you anticipate making way more than $100,000 a year, this is one of the many advantages of simply becoming a real estate professional. So anyway, you guys, those are some of the strategies that people use to avoid paying taxes. Legally, of course, and some of the strategies that you might be able to implement as well. Now remember, I'm not a CPA, and this is not financial advice, and this channel is purely for entertainment purposes only, and it's really up to you to do your own research to determine what is best for you and your specific tax situation, since we're all different. So anyway, if you guys enjoy videos like this, just make sure before you click out, just hit the like button. It does really help out a lot. I say it every video, but it truly does make a huge difference if you appreciate all the time I put in the channel. Also, if you watch all the way through, if you enjoy videos like this, just subscribe. 3 videos a week, and the best part about subscribing is that it's totally free. Even if you don't like my videos, which it's impossible. Why wouldn't you like my videos? But just saying, even if you don't like them, just still hit subscribe. You don't have to watch them, but just subscribe. Also, hit that notification bell so YouTube can send you a notification anytime I upload a video, which is 3 times a week. Also, lastly, feel free to add me on Snapchat and Instagram. I post there pretty much daily, so if you want to be a part of it there, feel free to add me there. Now this is lastly. I have a private Facebook group in the description for anyone who's interested in real estate investing, real estate agent, wholesale, real estate, anything real estate. You want to talk real estate, just add yourself to that group. It's free. Also in the description. Thank you again for watching, and until next time.